Hello, I'm Marshall Sykes with Capitano Investing Group, and today I have with me my business partner Courtney Moeller, and she's with Iron Horse 2 and the Iron Horse Energy Fund that we're going to talk about today. Courtney, would you like to introduce yourself
Oh, yes,
and
yes.
maybe just introduce yourself right now, and we'll go through the other piece in a bit.
Yeah, well, I'm honored to be here, and Marshall is fantastic. But my name is Courtney Moeller. I met Marshall several years ago in an alternative asset, group, and absolutely just loved him. We hit it off right from the get-go. We have very similar backgrounds, and we'll dig into that a little bit more. But thank you so much for having me.
Thanks, Courtney, for being here today and doing this. So I wanted for the investors out there, I just want to kind of go through this one more time, and I wanted to introduce Courtney to you and her team and let you hear it from her because I think that's important to see who we're in business with. And I think it makes people understand the deal a little bit better. Anyway, this is for accredited investors only, and the opportunity investment closes at the end of June. We may have a little bit of few days after that, but we're trying to get this wrapped up then. And as any with any investment, there's a risk involved, and I would like for you to read this as you go through the video and understand that there are risks and you need to understand that these are kind of investments that we're forward projections on that may or may not happen, but we think that's what we anticipate. But all the same, I need you to understand the disclaimers here. Um, and then again, Courtney, you grew up in um, an oil and gas family, really, right in the heart of the Permian Basin.
Yeah, I guess you would call me, second generation oil and gas. So grew up in Midland, Texas, which is right smack in the heart of the Permian Basin, which is the number one, producing basin in the United States. And my dad was a petroleum engineer. My brother drilled. My uncle has a well servicing company, and my sister hauls pipe out to the rigs and the wells. And so, but I mean, it's something that I have grown up and around my entire life. And we've actually even lived and drilled in Pakistan and Abu Dhabi. And my dad drilled in Jakarta for 20 years before he retired. And then in 2011, when he passed away, I inherited his oil and gas company. And we have continued drilling wells with companies like ConocoPhillips and SM Energy throughout the Permian Basin. Gosh, I can't believe it's going on 15 years now. So it's been a pretty incredible experience and something that we have a lot of depth of knowledge in. And oddly enough, it's exactly kind of my partner Rick, his background and story as well. He is also second generation oil and gas. He was an executive officer in the Navy. He was at the XO for a submarine, and we actually figured out that we were stationed in San Diego at the same time. And he got out of the military, retired, and went back to TCU, got his landman degree, and kind of same story as me. I was in the Navy, got out and got involved in oil and gas. He got out of the Navy and kind of followed in his family's footsteps as well. And then Landon is I guess he's kind of the VP of operations, but he does a lot of our underwriting and puts our financial models together. Also, a military veteran. He was a fighter pilot in the Air Force. So, just a really incredible team. Alexis helps me kind of do everything in the background, but I'm very grateful for them. They're very value based and aligned with me and what's really important to me. And I love working with them. They're great, great guys. We have a fantastic team.
Yeah, I mean, as you know, most of my investors, a lot of my investors are previous military, so veterans. So that your team fits right in with our community.
Yeah, I love that.
So here's your metrics for your Iron Horse team. Can you go through those?
Yes, and I love that we have this slide in here because this is not something that, Rick and I decide to do on the side after our W-2 job. This is our job. This is what we do all day, every day. And actually the metrics are even higher now. We've been involved with the two of us combined in more than 1,200 wells, more than 180 deals, And it's these numbers have actually grown since the production goes on every month. We're well over 200 million barrels of oil, a million BCFs of gas, 200 deals, and I'm really proud of that. And I think the other thing that is really great and something I want to point out is that in that more than 1,200 wells, we have only had 10 ever that either didn't produce or they were not able to bring them online. And so that number matters because we always get asked, what's the likelihood of drilling a dry hole? And that's changed a lot, with technology, but 10 in 1,200, so less than 1%. And it's not been in this last definitely not since Rick and I have been working together in the last few years. It was, more than a decade ago when those wells took place. So,
I'm gonna pause just for a second. Oh, sorry. I thought I was st pausing the recording. All right. Well, thanks, Courtney, on that. Let's go to your strategy for the deal.
Okay.
What, you're on mute right now, or your volume is not working.
Oh, there you go.
There it goes. Okay.
Perfect. Well, let's talk about the Iron Horse strategy because I think this is what is so special about our deal and what kind of differentiates us from a lot of other opportunities that you see out there. So first of all, we want to partner with major operators. These are going to be bigger companies like EOG, SM Energy, Anschutz, ConocoPhillips, Devon. Um, they have the economies of scale and their break-even prices are just lower and they get things done very quickly. And they have almost all the skin in the game. They have the majority of the skin in the game in every one of these wells that are being drilled. I really like that. We're also going to target top producing areas. We are not out drilling in random places. We are going to focus on everything from up in the Bakken, up in North Dakota, all the way down south to the Permian and Eagle Fords in Texas, right along that central area. And then we're going to target to bring at least 20 to 30 new wells into this deal. So major operators in top basins and a minimum of 20 to 30 newly drilled wells. And we've actually already bought the first seven. Five of the seven have already been drilled, and then we have three more that we're about to close on. So we're already making great progress on the deal and acquisitions.
All right. Good. Yeah, that sounds good. And the big thing I think for oil and gas is the tax benefits that people like to invest for. And the tax code allows this. But can you go through kind of how this works and with the Iron Horse?
Absolutely, because this is what is so special about, oil and gas, being able to take advantage of some pretty incredible tax benefits that are pretty specific to just this asset class. So, because of the I guess the nature of the investment, it is going to allow us to take advantage of something called intangible drilling costs. And those are the expenses that are not recoverable later on, things like fuel and labor. But the IRS says that if we actively participate as general partners in drilling wells, we can use those IDCs to offset W-2 income, active income, capital gains, pretty much just about anything. Now, we do also get to offset the tangibles. It's a much smaller percentage. And now, because of the bonus depreciation that's just changed, we get to take advantage of all of that in year one. But it's a small amount. The IDCs are really the majority of it. But the other great thing is the ongoing depletion allowance. What that is the first 15% of the income from the selling oil and gas every month is tax free for the life of the deal. So you get those first year amazing IDCs, and we're expecting it to be a minimum of 90% this year. And then you get that ongoing depletion allowance. So the tax benefits are pretty fantastic. Our fund one passed on 95.6, and we're expecting this one to be very similar.
All right. And the big key on any kind of deal is underwriting and how this is how Iron Horse is underwriting their deals. Can you
It,
explain a
it
little more?
is. Yes. And this is what's really important. And I think, we've been in an oil and gas kind of bear market for 2.5 years now, and up until this last few months. And, Even in January when oil was at $52, we were still making distributions to our investors, and it's because of our criteria. And like I said earlier, we're only going in with big operators. We want to drill with big operators in proven areas. When you drill in with these bigger companies in a tier one location like the Bakken or the Permian Basin, the success rates are 90% plus on horizontal wells, which is what we're drilling. $40 max even break even $40 max break even oil price. This is a big deal as well. Most of our companies we're participating with fall between that $35 to $40 range. It's typically right around $37. And that means even at $52 oil, we're still making money. We're still profitable. That is not negotiable. We're also targeting that K1 loss. Now, if our acquisition prices get too high, that means our tax benefits are going down. So we have really great access to deal flow. And if we can't get that break even price and the tax benefits to match, we're not going to move forward. Now, we do underwrite our oil. This is actually a little bit different. So we show returns at $72 oil, but if we can acquire the wells and they hit a minimum of a 1.x or greater on $65, that's a go. And then we do not want to own more than 10% of any well. So a lot of times we're coming in at 2, 3, 4, 5%. And this is a big deal because when you take a look at liability, and this comes up quite a bit, what is my liability? Could I potentially lose beyond my investment and things like that? That ownership percentage matters in a bunch of different ways. And just to give you a little bit of a perspective, let's say they're going to cap a well and it's $100,000. If we have a 5% interest, gosh, I don't even, my math is not mathing for me just yet. So let's see, on $100,000, if we have 5%, our liability or our responsibility of that is $5,000. And then if you take that and break that down to a $100,000 investor on this deal, it's 20 bucks. So I think, putting perspective in that, as far as being responsible for the cost to drill, being responsible for anything else that comes up, that 10% max ownership is really key in success as well, because we're not 100% responsible for anything going on any of our projects.
All right. And I think the big thing also is risk, and we show the top five risks here for this oil and gas deal, and the mitigations that we're going to put in place.
Right. Well, and this kind of goes back to that underwriting criteria because, the two biggest things are going to impact our project are the price of oil, which is that WTI benchmark, and then how the wells produce when they come online. And this is part of the reason why we want to perform, we want to drill with major operators in proven areas. And we have those low break-even prices because the price of oil is going to fluctuate, which is going to impact our returns. And we don't ever know what the price of oil is going to be. So if we've got those low break-even prices, that offers us a layer of protection. And then, no assurance of commercial production, that is drilling those dry holes. We have not had that happen. I have not had that happen since I have been participating with Rick. There have only been 10 and 1200. And with technology and horizontal drilling, that has almost been eliminated in these tier one areas. So, and we haven't had it happen in any of our projects over the last few years. There
Yeah.
can be delays, and there probably will be. Sometimes pipelines break and things break. Delays are going to happen. But this is also another reason why we want to have a really good amount of diversification. If we do have a well that's not producing what we expect, and that's going to happen. I mean, we're going to have some wells that have lower production, some in the middle, and then we're going to have some overproducers. That diversification builds in a really great layer of protection. And I didn't mean to cut you off, Marshall. What were you going to say?
No, this is exactly what I was going to say. I think the biggest thing I like is that you're drilling with multiple operators in multiple basins and a lot of wells. So, 20 to 30 wells. So a lot of the risk is mitigated with that strategy.
Right. Yes. And you don't really realize how important it is until you have a pipeline delay or, something else. And then you're like, okay, great. That's two wells out of our 30 well project. We've got 28 more that are carrying the weight while that repair is happening. And it's really, to me, I think the smartest and best way to invest in working interests in drilling wells. This last one is this monthly LOEs exceed income. That means the cost to keep those wells up and running is higher than the amount of money you're making. And this happens when the price of oil drops below that break even price. Fortunately, because ours is so low, we have not really had this happen. Rick did have a couple of deals during, after COVID, oil dropped down below zero, and he had a couple of projects that it impacted. But for the most part, the regular swings in the WTI price do not impact us because these operators, as Marshall knows, they lock in contracts. They're not just selling oil daily on a daily basis. They've got 30-day, 60-day contracts for the price of oil. So the fluctuations don't hit us. But if they do, and something were to come up and we did not make enough money to cover the expense, we also have a contingency fund in place. It's about 5% of the money raised that's sitting in an interest-bearing money market account. And we do have that to fall back on, should something arise that's unexpected.
All right.
And
And
the
this
other thing
is your,
I'm sorry, I do want to say one other thing. We have never had to come back and ask for investors to contribute a dollar beyond their initial investment in any of the deals that we have done.
that's a very good point. I mean, because that's always a concern when you're investing in a deal.
Always.
Yeah.
Absolutely.
And so this is your fund from Energy One, Iron Horse Energy Fund One that you did
Yes.
in 2025, I think, right?
Yeah, well, we moved, last year about the beginning of the year, I decided I wanted to stop doing smaller individual deals and start packaging things together and move to this fund model. And we closed Iron Horse Energy Fund 1 on December 30th of 2025 with just over $31 million. We've got 40 wells across multiple basins, multiple operators, passed on that 95.6% K1 loss that, I mentioned earlier. But I think the other thing that's so great is, I mean, we're just about to finish up that first 6 months. Most of our wells are online and producing now. We did start distributions May 1st, and we'll have the last handful of those wells finished up and online and producing here pretty quickly. So I'm very excited about how fast we were able to get that up and going because I talk to investors all the time. I had one of my guys that invested with me. He said, "This is amazing. I'm in another oil and gas project, and it's been 2 years, and we're still waiting for those wells to be completed." So I didn't mention this earlier, but we do a lot of acquisitions where they've already started drilling, and so we get to bypass a lot of a lot of that timeline, which is very advantageous for us and for our investors.
Oh yeah, that's a good way to do it if they've already got the plan in place to do the
Yeah,
drilling. But that's impressive to have a monthly distribution in month five. That's pretty impressive.
thank you. We're proud of it.
And as far as the Capitano Strategic Energy Fund, our fund size is around $4 million. The minimum investment is 75,000. Again, we're closed next week on June 30th. And then the whole period is roughly 7 to 10 years, depends on how the assets perform and when we decide to sell. And then distributions are monthly once they do commence. And we expect that to happen at the end of 2026, I think, or at the beginning of 2027, right? Roughly
Yeah,
6 months.
yeah, here, probably Q4. The great thing is, those first seven wells that we've already closed on, five of the seven have already been drilled. And so they haven't been completed. We're waiting for the fracs, but they've already been drilled. So we've already got some drilled wells before we even close this thing out, which is exciting.
That is exciting. Really nice. And roughly, as we talked about before, you're investing, a lot of people invest in this type of deal for tax benefits, and you get your return of capital within 2.5 years, and you can start putting that capital back to work somewhere, which is impressive. And you get a 90%, well, we're shooting for a 90% depreciation on the K1 tax loss
Yep. And you will get to use that for the 2026 tax year.
tax year. Okay. And then target return somewhere between 1.8 and 2.5. And as far as the investors GP split is 90 to 10 in the Capitano fund, but we're investing over $1 million into the Iron Horse fund, which would be an 83-17 split. So roughly, as an investor, it's roughly a 75-25 split. Um, And the timeline, again, we're at the end of June now, so the fund's open and they've already started acquiring assets, as Courtney has said, and they're starting to produce here shortly, and then monthly distributions by the end of the year.
Yeah, and one thing I do want to talk about on the distribution side. So when these wells come online, we start earning the moment those wells are producing and they're selling oil and gas. The one thing we do not have control over is when the operators start the distributions. And I just wanted to give an example on that. So like Iron Horse, we have all those wells, the operators have not started distributions on all of those deals, but we're earning. So like we have one well that came online in October, so we're already at almost 8 months of, production on that well. Well, we're expecting that to happen probably here in July. So we're probably going to get a really big, like 8 month check with, that first payment, and then it'll roll into monthly. So the distribution start, it's going to be kind of staggered with these different operators, but the second those wells come online, we're earning our ownership, our percentage of ownership in those wells. We start earning, and then we're just waiting on the distributions to start.
All right, thank you. So the investment process, just understand the deal by watching the replay or looking at the materials in the data room. There is a data room in the cash flow portal, the Capitano Investing Group cash flow portal, which is you can find right there, or I'll send it in an email as well. And then, as most of you probably have invested already, but I can walk you through the process of investing if you haven't already. And basically, you sign investment documents in the portal, and you provide an accreditation of your accredited status, and then fund the investment. And then I fund through up to Iron Horse after that. So let me see. Any questions? Just give me a call and I'll be happy to answer them or just email me or text me. But we're looking forward to this investment with you, Courtney, and really appreciate your time today. Any other things that we need to talk about or maybe some frequently asked questions that pop up that others that may be beneficial to the investors?
One of the questions I do get is the dry hole situation, which we talked about. But the second one is, can I invest from an LLC or do I need to invest as an individual? And I would say that you want to invest where you want the tax benefits to flow. And as an individual, if you're wanting to use it to offset your W-2 income, you need to come in as an individual or with a single member or disregarded entity. If it's a single member LLC, the tax benefits will flow through to you. But if you invest with a multi-member LLC, the tax benefits are going to stop at that LLC. And we do have a lot of people that will come in as an individual, and then once they're converted to a limited partner, which we did not talk about, you will invest in this as a general partner. And then once drilling is completed and paid for, we convert you to a limited partner. And at that time, people can have converted their deal into an LLC or moved it into a trust or something like that. So those options are out there.
So if all of the drilling is done by the end of 2026, you can convert them in 2027 to LPs,
Yeah,
correct?
we're expecting that to take place on January 1st, but it's not just the drilling is completed. We need to make sure that the drilling is completed and completely paid for. So once those two things are for sure, and once they're online, we know that that is the case. But sometimes they'll go in, we think they're finished, but then they go in and maybe they refrac or, they've got to do something additional that wasn't expected. And, it might not have been completely finished. So we wait until the all drilling costs are completely paid. So it's completed and paid for.
All right. Okay. Appreciate that.
Yeah.
Again, if any other questions, just reach out to me and I'll be happy to answer them. And we can bring Courtney on if there are some deep questions that you don't understand. I'll also send out the frequently asked questions to everybody to make sure that you have the ones that most people are thinking about. Again, Courtney, thank you for your time today, and we'll
Yeah.
talk
Thanks
to
for
you
having me.
soon.
Okay.
Oh, yeah, let me see. Yeah, here we go. I'm not great.